Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. Today is May 19th. I'm a day late from getting this last week's market insights out. Inflation bites, but Wall Street bites back. Stocks were mixed last week as investors fretted over hot inflation reports, which offset the move in chipmaker stocks. The S&P 500 index rose 0.13%, while the NASDAQ Composite Index edged down 0.08%. The Dow Jones Industrial Average lost 0.17%. The MSCI EAFE Index, which tracks developed overseas stock markets, declined 1.77%. It was a volatile week. The S&P 500 index edged up about that 0.1% last week. Its seventh consecutive weekly gain as strong advance in energy stocks help outweigh declines in other sectors. The S&P 500 ended the week at 7,408.50, up slightly on the week, but down from the new closing high it reached Thursday at 7,501.24. The market benchmark also hit a new intraday high on Thursday at 7,517.12. The 7-week win streak is the index's longest since a 9-week run. It ended in December of 2023. The S&P 500 now is up about 2.8% for the month and has climbed 8.2% in 2026. The week's advance was driven by gains in only 4 of the S&P 500's 11 sectors, led by energy amid surging oil prices on the back of renewed Middle East worries. Consumer staples, technology, and healthcare also rose this past week. Declines across the remaining 7 sectors came amid inflation concerns. U.S. annual consumer inflation accelerated in April to the fastest pace in almost 3 years as energy prices surged amid the near-complete closure of the Strait of Hormuz. Data released this week showed Another report showed U.S. producer prices in April rose at the fastest pace in 4 years as the broad-based increases in services and goods signaled intensifying inflation pressures. The energy sector jumped about 6.8%, followed by gains of at least 1% each in consumer staples, technology, and healthcare. Occidental Petroleum and Targa Resources had the largest percentage gains in the energy sector for the week, rising 12% and 9.6% respectively. The climb in consumer staples was led by shares of tobacco companies Philip Morris International and Altria, which added 11% and 7.3% respectively. The technology sector's gain came amid enthusiasm for artificial intelligence as Cisco Systems reported higher than expected quarterly results. Boosted by strong demand for its AI infrastructure, Cisco's shares jumped 22% as the company reported fiscal Q3 earnings and sales above market expectations and raised its full-year guidance. On the downside, consumer discretionary fell 3.1%, followed by a 2.6% drop in real estate, a 2.3% loss in materials, and a 2.1% decline in utilities. Industrials fell 1.1%, while communication services and financials also edged lower. Norwegian Cruise Line Holdings was among the hardest hit in the consumer discretionary space. The cruise operator shares fell 9.1% as TD Cowen cut its price target on the stock to $22 each from $27. The firm kept its investment rating on the shares as a buy. Okay, weekly market insights. Major index return summary. 1-year trailing number for the NASDAQ is up 14.83%. S&P 500's up 10.04% in the last year. Dow Industrial's up about 4.71%. MSCI EAFE is up 7.91% over the 1-year trailing number. However, over the 1-month trailing, NASDAQ's up 12.71%. S&P's up 7.74%. Dow Jones Industrial is up 3.22%, and MSCI is kind of flat at up 0.26%. 10-year Treasury notes trading around 4.59%. That's up 6.99% over the last month. Month ago, it was trading around 4.29, so we've had yields pop back up a little bit. Again, inflation's in focus. Both retail and wholesale inflation rose faster than expected in April, heavily influenced by higher energy prices. Everybody's feeling it at the pump. I know I did when I was filling up my truck. I think I dropped like $125 on about 30 gallons of gas. That was a little more than I wanted to, obviously, but I think it's going to be a short-term spike given the war that happened in Iran versus US. So the CPI increased 3.8% year over year in April. That's up 3.3% in March. Fuel oil alone climbed 54% year over year, while gasoline jumped 28%. In fact, over 40% of the 0.6% month over month gain was driven by energy inflation. Inflation also showed up in wholesale prices. The producer price index rose 6% over the prior 12 months in April, also a 3-year high. Month over month, PPI rose 1.4%, a 4-year high versus the 0.5% increase expected. This week, key economic data, we're tracking pending home sales. Philadelphia Fed President Anna Paulson speaks. Wednesday's minutes from Fed's May FOMC meeting, we'll be checking in on that. Weekly jobless claims on Thursday. Housing starts, building permits, purchasing managers index, and manufacturing. We'll check those PPI numbers. All right, Friday, consumer sentiment, leading economic indicators. This week, notable companies reporting earnings. The Home Depot on Tuesday. Wednesday, NVIDIA, Analog Devices, the TJX companies, Lowe's companies, and Intuit. Thursday, Walmart and John Deere are reporting, so we'll be tracking those companies as well. Your plans this summer may be eligible for itemized deductions. These activities can be itemized as deductions if you have plans to sell or buy a home this summer or to donate some old items. Here are some examples. This is your tax tip of the week, if you were wondering. If you are refinancing your home this summer, you can deduct some of your mortgage interest. However, there are some limits to these deductions. According to the IRS, the deduction is limited to interest paid on a loan secured by the taxpayer's primary or secondary residence. When refinancing, you must use the loan to purchase, build, or substantially improve your primary or secondary residence. If you buy a new home this summer, you can deduct mortgage insurance if you pay $750,000 in qualifying debt for the first and second home, or $375,000 when married and filing separately. Summer is an ideal time to sort through your belongings and donate any unwanted clothes, furniture, or household goods. If you itemize the deductions and provide proof of the donations, these donations may qualify for a tax deduction. In addition to donating items, you can deduct mileage on your vehicle for services performed for qualifying charity. This information is not a substitute for individualized tax advice. Please consult with a qualified tax professional to discuss your specific tax issues. And this tip was adapted from irs.gov. All right, stay tuned for the next segment. We got a good show for you. What would you do with the windfall? After years of walking clients through inheritances, business sales, bonuses, and liquidity events, we have seen how these moments unfold in remarkably consistent ways. There is almost always a boat or something like one, a vacation home, a renovation, a car that was never quite justified before. None of it is wrong on its own, but how a windfall is handled in the months immediately following its arrival often determines whether it becomes the foundation for something lasting or whether short-term decisions quietly limit the outcomes that could have been possible. A client calls us, voice equal parts excited and anxious. They let us know they're receiving a large inheritance or their company was acquired. The number they're about to receive can be life-changing by any measure. What happens next? In the weeks that follow, we'll see the full range of human nature, the disciplined and impulsive, the generous and the fearful. And after working a long time as a financial professional, we've noticed that people's instincts in the first 90 days can often determine whether a windfall becomes a foundation for generational wealth or a brief episode in their financial story. With the largest wealth transfer in American history now actively underway, Sorelli Associates projects that $124 trillion in assets will change hands through 2048, with nearly 100 trillion flowing from baby boomers to the silent generation to their heirs. When the transfer happens, the conversation is no longer hypothetical. It becomes immediately real for many families. If you haven't personally experienced a windfall yet, but think you may get one at some point, it makes sense to start preparing. So again, projected total U.S. wealth transfer through 2048 per Sorelli Associates 2024 report, approximately $62 trillion is expected to come from just the top 2% of households. We're not bringing this subject up to lecture anyone. We're talking about it because we've seen what works and what doesn't. We hope the patterns we share on this podcast make it easier for you and the people you care about to navigate one of life's genuinely complicated moments. So the first 90 days where windfalls are won or lost, whether it's an inheritance or a business sale, one of the single most important things to consider after receiving a financial windfall is to pause before making any major financial decision. The first 90 days are almost always the most consequential and are often when people make common mistakes, as early emotion may outpace strategic thinking. There's a psychological phenomenon that behavioral finance researchers call the, quote, house money effect, end quote. This is a well-documented tendency for people to treat unexpected money as fundamentally different from money that they've earned, often leading to greater risk-taking and more impulsive spending. The rational part of our brain knows that a dollar is a dollar regardless of its origin, but emotionally, windfall money often feels like bonus money, so it's treated accordingly. Here's what we often see in those early weeks. Lifestyle upgrades that often happen faster than other factors that are considered. Loans to family members are made under emotional pressure before any strategy is in place. Investment decisions can be made on a hot tip from anyone, from a brother-in-law to a podcaster. Money is spent on a vacation, a renovation, or a new car, often all three simultaneously. Nothing for too long. Complete paralysis occurs because the numbers feel too large to touch. There's some of that too. That last one surprises people, but analysis paralysis is common, particularly with large inheritances, where the emotional weight of a loved one's death makes the money feel both precious and untouchable. So the cash sits in a bank account, not producing a return for an extended period of time. So here's our rule of thumb. Before making any financial move following a windfall, consider waiting until you have the opportunity to consult with your financial professionals, like your financial advisor, your CPA, your estate planning attorney. The 5 patterns we see most often, even though all of our clients over the years have been unique and we help each craft a personalized financial strategy, we do see patterns emerge that we address and try to course correct when it comes to sudden changes in wealth. Number 1, the lifestyle leap, the most common pattern of all. The new house gets bought, the cars get upgraded, and the vacation budget suddenly doubles or triples. None of these things are inherently wrong, but we've watched more than a few clients make lifestyle commitments that require ongoing income to maintain, only to find that the windfall itself may not generate enough return to sustain that newly lavish lifestyle forever. So proper planning needs to be in place prior to doing that. A client once received a $3.5 million inheritance and, over the following 18 months, committed to a vacation home, a boat, a private school tuition for 3 children, and a home renovation. The commitments were entirely serviceable, but they locked up more than half the principal and created ongoing carrying costs of roughly $180,000 a year. A windfall that could have been generational became merely comfortable. Comfortable is fine, but take the time to understand the trade-offs. Number 2, the family first impulse. Generosity is one of the most beautiful things about a windfall, and the pressure to share it from adult children, siblings, parents, and old friends can be intense. The reality check, 72% of Americans say they don't feel confident in their ability to manage a large financial windfall. Yet those same people often feel quite confident in their ability to give it away. We're not suggesting that gifting is wrong. In fact, strategic gifting is one of the most powerful tools in an estate strategy. But there's a difference between a thought out gifting strategy with proper documentation, tax awareness, and investment in the recipient's financial education, and writing checks in the first few weeks because saying no feels stingy and impossible. For 2026, the annual gift tax exclusion is $19,000 per person or $38,000 for married couples filing jointly. These are amounts that can be given without touching the exemption for lifetime gifts. Your tax, legal, or accounting professionals can offer some insight. Number 3, the DIY investor. Some people who receive a windfall consider becoming a do-it-yourself investor, often underestimating the complexity involved. Windfalls have a way of generating investment confidence and that playing with house money effect that we talked about in the summary. Someone receives $800,000 and suddenly feels they should manage it themselves, perhaps because asking for help feels like admitting they don't know what they're doing. The data here is not encouraging. Only 20% of Americans say they would seek guidance from a financial professional after receiving a windfall. This could be short-sighted because making investment decisions isn't always easy or intuitive, particularly if you've never done it before. A financial professional will work with you to understand your goals, time horizon, and risk tolerance before suggesting an overall financial strategy. Number 4, the paralyzed inheritor. Sudden wealth syndrome, a term first identified by psychologist Stephen Goldbart in the 1990s, describes the psychological and emotional distress that can accompany an unexpected windfall, and it's real and it's more common than most people expect. Symptoms include anxiety, guilt, social isolation, and difficulty trusting the motives of people around them. For many inheritors, the grief of losing a parent or a loved one is bound up with the windfall itself. The money arrives at the worst possible emotional moment, making decisions feel like desecrating something sacred. So nothing happens, sometimes for years. If you haven't yet, consider the emotional toll of cleaning out and selling the family home where you were born and raised. It's understandable for some to want to avoid tackling that piece of a windfall. The cost of paralysis is real. What may help? You might ask. Having a trusted financial professional who is a neutral party takes some of the administrative burden off the early months while creating a gentle structure for decision making. The finances can wait for a while. The grief shouldn't have to. Number 5, the one who gets it right. So there is a 5th pattern, and it's the one we steer our clients towards. It's when the client pauses for an appropriate amount of time, assembles a team of professionals, thinks carefully about what this money is actually for, reaffirms their values and their own goals, and then builds something that can outlast them. These clients tend to share a few traits. They're willing to talk honestly about money with their family. They're curious rather than embarrassed about what they do not know, and they have a clear sense of what they actually want their wealth to do. They give intentionally with purpose. They invest strategically, and they think generationally. They take care to not increase their reoccurring lifestyle expenses too much. Why this conversation is more urgent than ever? We're in the middle of the largest generational wealth transfer recorded in history. And again, according to Sorelli Associates, their 2024 report, more than 50% of the total projected transfer, approximately $62 trillion, will come from high net worth and ultra high net worth households and transition down. And $18 trillion of it is expected to flow to charitable causes. Generation X will inherit the greatest amount in the next decade, projected about $14 trillion. At a pivotal life stage when many are simultaneously caring for aging parents and still financially involved with their adult children. Millennials, meanwhile, are projected to be the largest inheritors over the full 25-year period from now, receiving an estimated $46 trillion. These numbers matter not just as statistics, but also as a strategic reality for every family. If you're in your 50s or 60s and your parent is aging, the question is no longer, will this happen? It's, are we prepared for when it does? And if you're on the giving side of this transfer, the question is equally important. Have you set up your heirs to receive your wealth wisely? You already know that they don't want your wedding china or Hummel collection, but have you had the financial conversations? Have you structured your estate to reflect your values, not just your balance sheet? What actually works is a framework for windfall decisions. After years of watching these events unfold, we've developed a straightforward framework that we walk our clients through whenever a windfall event is on the horizon or has just arrived. So, step one, secure before you decide. The first step after receiving a windfall is to receive the funds without committing them to anything. Give yourself permission to simply breathe and grieve. Step two, get the right people in the room. So consider working with a team of professionals before making any decisions. These conversations can help you start to create an overall strategy for the windfall. Step three, name the why. So the purpose. What is this money actually for? Is it for retirement, for helping your children, creating a legacy, a mix of everything? Clients who can articulate a clear purpose for their windfall are often better equipped to make the dozens of smaller decisions that follow. Without the why, every decision can feel equal and arbitrary. Step four, cover the basics. Before making any major decisions, it's always a wise idea to look at your overall financial picture. This can include reviewing any high interest debt or other obligations. And step five, build a spending permission slip. So one of the healthiest things we can do for our clients who receive large windfall is to encourage them to designate a small percentage, often 3% or 5%, explicitly for guilt-free enjoyment, a trip, a renovation, a gift to each adult child. Having a defined way to enjoy the money can help with the psychological pressure that leads to big impulsive decisions. And here's a note on inherited IRAs, if you were wondering. If your windfall includes an inherited IRA or a 401k that gets inherited, don't hesitate to get in touch with us. We can talk about those things. The 10-year distribution rule introduced by the Secure Act, clarified in regulations finalized in 2024, requires most non-spouse beneficiaries to fully distribute inherited retirement accounts within 10 years of the original owner's death. There are strategies to consider exploring before distributions begin. And so if you're not clear on that, it's important. The bottom line is a financial windfall is one of the few moments where decisions you make in a short window can genuinely alter the trajectory of your family's financial story for better or worse. Frequently asked questions about financial windfalls that we fielded, or how long should I wait before investing money from an inheritance or windfall? Again, consider waiting for a period of about 90 days before making any decisions. Assemble your professional team, understand implications of certain decisions, and clarify your goals. Number two, what are the biggest financial mistakes people make after receiving a windfall? The 5 most common we see are making large lifestyle commitments before a strategy is in place. Get the strategy in place, then go through that process, giving money to family under emotional pressure, attempting to manage the money without professional guidance, making no decisions at all due to paralysis or grief, and failing to address the tax implications in the first year. Do I need to work with professionals if I receive a large inheritance? That's number 3. Professionals can help you develop a long-term strategy aligned with your goals. A tax, legal, accounting professionals can help you address the tax situation. An estate attorney can help you with your estate strategy. If you don't already work with a team of professionals, it may be time to work with somebody, especially when you get a large windfall. And number 4, what taxes do I owe on an inheritance or windfall? Tax treatment varies by windfall type. Every windfall situation has a unique tax profile, which is why consulting tax, legal, or accounting professionals can also be helpful. A financial professional can also help play a role, and an estate attorney may be helpful too. So we're here for you before, during, and after a windfall, and we're here to help you navigate your financial life including any sudden change in your wealth. A windfall can be a great thing, but also brings its own complexities and stresses that we need to address carefully. So, more money, more problems. Yeah, that's probably true. That is true. If you have questions about this or more, you can always reach out to us at Northbound Wealth Management. We'd be happy to chat with you. Stay tuned for the next segment. So, according to a Yahoo Finance article, is the SpaceX IPO overpriced? Here's how much it could be worth, according to a valuation expert. This article was written by Adam Levy at the Motley Fool, but Yahoo Finance picks it up. SpaceX is set to make history this summer with its public market debut. The company confidentially filed for an IPO, or an initial public offering, with the Securities and Exchange Commission in April, aiming for a potential listing in June. The company could be valued at $1.75 trillion or more, offering $75 billion of stock to the public. It would be the largest IPO ever. To put that into perspective, there's only a handful of companies, public or private, that are valued at more than $1.75 trillion. It's easy to forget the fact that when some of the most popular companies in the world are also worth trillions of dollars, but only 8 companies are currently valued higher than SpaceX's target. By the way, as an aside, there's a lot of companies staying private longer, so this is not unexpected. When companies like this come out, it's going to be added to the triple Qs or the NASDAQ Composite Index. They're listing on the NASDAQ. So if you own the Qs, you're going to own part of SpaceX anyway by default. So some of these big unicorn IPOs are staying private longer. They bring higher valuations in the markets when they do list. Let's continue with this article. That may make investors wonder whether the Elon Musk-led company is really worth the price. The, quote, dean of valuation, end quote, New York University finance professor Aswath Damodaran recently took a look at the limited publicly available information about SpaceX financials and made his best guess on how much the company is actually worth. Here's what he thinks about the blockbuster IPO. Evaluating the 3 businesses within SpaceX, you got to do that. SpaceX is a company without comparison. It operates 3 main businesses: space launch services, satellite internet service, and artificial intelligence lab, so an AI lab. Writing in a blog post, Damodaran looked at each business separately and evaluated its future addressable market, SpaceX's potential market share, and the company's operating profits. Damodaran also sees the potential for Musk to find another business opportunity that he incorporated into his model. He sees future revenue potential across all 3 existing businesses and any future business reaching about $320 billion, with a blended operating margin approaching about 50%. Ultimately, discounting SpaceX's future cash flows at its 8% cost of capital led Damodaran to a $1.22 trillion valuation. That $1.22 trillion valuation is certainly lower than the proposed IPO value of $1.75 trillion, which should give investors pause when deciding whether to buy the stock at its debut. However, Damodaran also notes that there's significant uncertainty in the business, which puts $1.75 trillion within a reasonable range. What's more, the uncertainty is skewed such that there's more upside potential than downside risk, he thinks. He also notes that the details yet to be revealed in the public IPO filing are unlikely to make a significant difference in his valuation, since it's based heavily on the company's potential future earnings, like all companies, actually. After all, SpaceX reportedly generated just $15.6 billion in revenue last year, which is incredibly small compared to the growth Damodaran sees ahead of it and relative to its projected market value of 112 times sales. But there's a few things investors should consider carefully before the IPO. A closer look at SpaceX's competitive advantages. SpaceX launch services and satellite internet businesses hold incredible competitive advantages. That's because SpaceX has been developing reusable rockets for 24 years. The ability to reuse rocket parts or engine or an entire rocket, it reduces the time between launches and the cost per launch. That lead could expand if it successfully launches Starship, a gigantic, fully reusable rocket. SpaceX's cost advantage in launch services enabled it to put thousands of satellites in orbit to support its satellite internet service, Starlink. That's given it a significant advantage in attracting and serving customers at a high profit margin, while other competitors struggle to make the economics work as well as SpaceX has. The same advantage also extends to SpaceX's plans for orbital data centers. Deep-pocketed competitors, including Amazon and Alphabet, are also working to build satellite constellations for internet service and data center operations. But both tech giants have a partner to launch companies to put their satellites in space. Alphabet is notably in talks with SpaceX for its launch services, while Amazon's Project Leo is behind where it intended to be when it applied for the Federal Communications Commission to launch its constellation. As a result, SpaceX should be able to maintain a dominant market share in both launch services and satellite internet. How big these markets become is uncertain. Mondrian sees the market for space launches expanding from 30 billion to 100 billion in 10 years, and the market for satellite internet expanding tenfold to reach 160 billion. SpaceX doesn't seem to have any advantage as an AI lab, though, and that could weigh on its profits for a long time. Mondrian expects XAI to carve out a niche with its consumers that could ultimately keep its revenue small but profit margin high. Still, he expects the businesses to account for 25% of SpaceX's total revenue in 2036 or 80 billion. However, I believe the market will consolidate to just a few dominant players, leaving little revenue for anyone else. I also think consumers will want to use the same AI models as they do at work. Although the core businesses provide a base level of certainty for SpaceX and AI businesses and business exploration create significant risks, the market already pricing the IPO higher than Mondrian's valuation, investors will likely be better off waiting for cheaper entry points, especially after the 6-month lockup when private investors can then dump the stock on the public market. So that's something that we're having to take into consideration. That opportunity could present itself at some point too. Early pre-IPO SpaceX investors, including Alphabet, will likely want to liquidate their shares. And funny, I just said that. To diversify and explore additional investment opportunities, there's other IPOs coming out this year, like potentially Anduril or ChatGPT, OpenAI company. So that could put tremendous selling pressure on the stock, considering only about 4% of shares will be made available through the IPO. And so we're going to be tracking this IPO. We think it's going to happen around June 12th. So investors get ready for that roadshow beginning in June 8th, I think, is when they're going to start roadshowing. All right, stay tuned for the next segment. So, according to the Motley Fool, how much will SpaceX stock be worth by 2030? Here's what history says. So, with whispers of valuations approaching $2 trillion, SpaceX stands on the precipice of potentially the largest IPO in history, yet forecasting the company's stock price at 2030 feels more like an astrology project than an astute financial analysis. SpaceX must overcome regulatory hurdles and make significant technological leaps over the next few years to meet investors' sky-high expectations. Let's explore where SpaceX stands today, detail the company's vast opportunities, examine some sobering lessons from recent high-profile IPOs. So putting SpaceX valuation into perspective, and this is the key point. A lot of people are trying to figure this out because it's how much you pay for these things when they come out. It's just what kind of premium, that type of thing. So let's take a look at the SpaceX's valuation trajectory last couple of years. So in late 2024, SpaceX bought back shares from employees for about $185 each. This secondary share deal valued the company at about $350 billion. 1 year later, a tender offer pushed the company's worth to $800 billion by December of 2025, obviously more than doubling. Earlier this year, SpaceX merged with XAI in a $1.25 trillion transaction. Most recently, shares of SpaceX hit a valuation of $1.5 trillion on Forge Global's private market trading platform, which I've been following. I've been just watching this thing continue to climb. The company is reportedly eyeing an IPO valuation between $1.75 and $2 trillion. For context, the company would be valued higher than Walmart, Samsung, Meta, which is Facebook, and Tesla, At the high end of this range, given SpaceX's S1 filing remains confidential, investors only have estimates of the company's value and revenue and profitability. Some analysts estimate that SpaceX generated between 15 and 16 billion in revenue last year, while others put the company's top line closer to 18 billion. Regardless of the precise sales figure, SpaceX's IPO valuation implies a price to sales multiple exceeding 100. um, Separating SpaceX's actual businesses from its lofty goals. So the company's reusable rockets, again, helping SpaceX capture lucrative contracts across commercial and government sectors. Meanwhile, Starlink has evolved from a niche connectivity provider to a global broadband network. So the real multiplier for SpaceX is artificial intelligence. The company is increasingly marketing itself as an orbital AI infrastructure provider, leveraging Starlink's network and Starship's launch capacity to deploy data centers in space. The pitch looks compelling on the surface. Orbital compute can sidestep Earth's power grid and cooling bottlenecks, offering greater scale for training and inference workloads. Reports claim that SpaceX estimates its total addressable market, or TAM, to be around $28 trillion, with the vast majority tied to enterprise AI. These technology IPOs might be a good proxy for SpaceX's fate. After a direct listing in 2020, Palantir, which a lot of people know of, faced loads of skepticism over its lumpy government heavy revenue and recurring operating losses. A strategic pivot towards commercial AI applications fueled top line growth and helped widen the profit margins for Palantir. Since bottoming around $6 per share in 2022, Palantir stock has gained more than 2,100%. So that's a good proxy. Snowflake followed a completely different arc. Its 2020 IPO popped dramatically on the first day of trading. Ultimately, it surrendered these gains due to high interest rate environment from the Fed over the years since 2020 and normalized growth rates. Investors who bought near the peak remain in the red years later, so it didn't really work out as much. I know that Warren Buffett had like a $500 million investment early on in Snowflake. I wonder if he's still in it. I'd have to look. Let's see. Most recently, Figma and Celebras systems delivered outsized first-day surges driven by enthusiasm across high-growth software and next-gen chip architectures. Figma's momentum eventually settled into a more measured trajectory, with shares now hovering well below their level in the early trading days. For now, it's too early to call if Celebras stock will maintain its premium as the company works to convert backlog from OpenAI and Amazon Web Services into durable revenue against larger chip rivals like Micron and AMD. All right. History shows that high-profile IPOs generally come with immediate hype, okay? Pump it up, right? And then valuation premiums that are driven by narrative. These frothy valuations can persist if business fundamentals compound rapidly and execution matches that growth story, as with Palantir, case in point. More often, however, IPO stocks erode in the first year after lockups expire as actual quarterly performance replaces inspiring rhetoric. SpaceX enters the public markets under immense scrutiny. Its IPO will almost certainly price shares at a premium, reflecting the assumed synergies between AI and the final frontier, but the company's valuation in 2030 remains anyone's guess. Maintaining a $1 trillion profile will require Starlink to scale and to serve tens of millions of users, Starship to achieve routine launches, and orbital AI to evolve from an interesting concept into a revenue-generating business. Execution delays, geopolitical tensions over orbital routes, dependence on Elon Musk, and the possibility that AI compute economics favor ground-based solutions are all genuine risks for SpaceX. Buying SpaceX at its IPO price requires accepting extreme valuation and volatility risk. Absolutely, 100%. A single missed milestone or change in perception could easily trigger a steep correction in the last several years. Meanwhile, flawless execution from Musk and his team could meant generational wealth. While the stars are within reach, the journey will undoubtedly test even the most patient investors. So, if you're gonna allocate to SpaceX here in the next few weeks, when we hit June and the IPO is actually launched, you got to be ready for some volatility and potentially some sell-offs, some hard corrections. There's going to be some short theses out there and bears trying to take out the stock, which all of it works together actually to get us to more transparency and understanding the company and its future. But over the long run, not advice, but I think I might allocate a little bit of my own personal money to it. Like this article and like what we talked about, it could be generational wealth just to own a piece of the space company. It's probably going to be the 800-pound gorilla in the room on this one. So anyway, food for thought. Thought it'd be fun to cover SpaceX as we're approaching its launch in the public markets as an IPO. All right, stay tuned for the next segment. So, according to a CNBC Disruptor 50 article by Samantha Subin, published May 13th and updated on May 18th, the headline reads, Anduril doubles valuation to over $60 billion as defense tech funding boom continues. So here's some key points. Anduril raised $5 billion in a funding round led by Thrive Capital and Andreessen Horowitz, doubling its valuation to $61 billion. CEO Brian Schimpf said Anduril will aggressively invest in manufacturing research infrastructure to support U.S. defense systems. The Palmer Luckey founded startup is positioning itself as a major winner in the U.S. government's race to reindustrialize the U.S. military under President Donald Trump. So defense tech startup Anduril on Wednesday said it raised about $5 billion, doubling its valuation to $61 billion in a funding round led by Thrive and Andreessen. Oculus headset creator Palmer Luckey, who founded the company in 2017, said he would definitely take the company public in an interview with CNBC last year. Okay, so that's what he said. So he said, quote, when we founded Anduril in 2017, defense was not a category that attracted significant venture investment. It has changed meaningfully over the last several years, Schimpf said. That's the CEO of Anduril. Defense tech startups have seen a bonanza in funding, including recent rounds from Shield AI, autonomous ship maker Saronic, and several space companies. Anduril is also positioning itself as a key beneficiary of the U.S. government's race to reindustrialize the U.S. military under Donald Trump, the President of the United States. The company recently joined a group of companies working on space interceptors for Trump's ambitious $185 billion missile defense system dubbed the Golden Dome. This year, Anduril landed a 10-year U.S. enterprise contract with $20 billion ceiling and acquired a space missile and satellite tracking company. Anduril is also one of several Silicon Valley backed firms shaking up the defense contractor space, dominated by companies like Lockheed Martin, Northrop Grumman, and Raytheon Technologies. The Department of Defense on Wednesday also announced an agreement with Anduril, Co-Aspire, Leidos, and Zone 5 to buy more than 10,000 low-cost hypersonic missiles over the next 3 years. So, military defense investment has ramped up significantly, especially after the U.S.-Iranian conflict, and remains to be something that the U.S. is going to be investing in over the foreseeable future. So we'll be tracking that potential IPO as well.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.